Every candle on your chart is hiding a secret. It isn't random and it isn't magic. It's the result of an auction. And once you understand that auction, the chart stops looking like noise. Markets have run as auctions for centuries, from noisy grain pits to the trading floors of Wall Street. But in the 1980s, a trader at the Chicago Board of Trade named Peter Steidlmayer turned that chaos into a framework. He called it market profile. And the idea underneath it, auction market theory, is what we're unpacking today. Picture a classic auction house. One painting, a room full of bidders, each willing to pay a little more to win it. The price climbs for one reason only. Someone keeps raising their hand. Markets work exactly the same way, except there's no single painting. At every price level, buyers are bidding and sellers are offering, all at the same time. The economists call this a double auction, and unlike the auction house, it never closes. Zoom all the way in and you'll find the order book. Above the price sit resting sell orders, the ask. Below it, resting buy orders, the bid. The gap between them is the spread. These orders just sit and wait. On their own, they move nothing. Price only moves when someone gets impatient. A buyer who refuses to wait pays the ask, lifts those sell orders off the book, and the trade prints. That match becomes the new price, and your candle ticks up. When sellers hit the bids instead, it ticks down. Here's the part most traders get backwards. Price does not rise because there are more buyers than sellers. Every trade has a buyer and a seller. Always a perfect match, 1 for 1. Price rises because buyers are willing to accept worse and worse prices just to get filled. They chew through the resting liquidity and the candle tears upward. Markets move on urgency, not on headcount. And let's clear something up. It's not ICT secretly moving the market. It's not an invisible hand, a smart money cabal, or some shadow algorithm hunting your stop loss. You do not need electronic versus regular hours overlays or 17 indicators stacked into a wall of complicated nonsense. The mechanism is gloriously, almost insultingly simple. Buyers, sellers, and a price. From this tug of war, two states emerge. In balance, both sides quietly agree this is a fair price. Trade flows back and forth and price drifts sideways. Then something shifts. News, fear, a change of conviction. And one side turns aggressive. That's imbalance. Price leaves the area fast, hunting for a new level where the other side finally pushes back. Balance, imbalance, balance again. That rhythm is the heartbeat of every market. Now watch what a real range looks like. Price oscillates inside a zone. Buyers defend the floor, sellers cap the ceiling. Every so often it pokes above the ceiling and gets rejected straight back in. Then it probes below the floor and snaps back again. Those are the edges being tested, until one push finally sticks. Price breaks out, expands, and builds a brand new range, higher, and then the whole dance repeats. Now add volume, the record of how much actually changed hands at each price. Turn it on its side and a shape appears, the volume profile. Where the market spent time agreeing, volume stacks up tall. That fat middle is the value area, roughly 70% of all activity, the market's comfort zone. The single most traded price is the point of control. Push far outside the value area and you're an outlier, and outliers tend to snap back toward fair value. But markets never move in clean lines. Again and again, price probes above value, finds nothing but eager sellers, and gets slapped straight back inside. That's a failed auction, a rejection. And these failures are gifts. They mark the exact spot where one side has quietly seized control. Here's where it gets powerful. Turn that volume on its side, and the auction prints a letter. 3 shapes show up again and again, the D, the P, and the B. Each one tells you who's in control, and each one comes with a play. First, the D, a clean bell curve, fat in the middle, balanced on both sides. This is a market at peace, buyers and sellers agreeing on fair value, with the point of control sitting dead center. So how do you trade a D? You fade the edges. When price stretches to the top of the range, sellers tend to step in. Look for shorts, back toward the middle. At the bottom, buyers defend. Look for longs, back to value. Stop just beyond the edge. You're betting that balance holds. Next, the P, a fat head up top with a thin tail trailing below. This is aggressive buying. Price ripped higher, then balanced at the highs. Often it's short covering, trapped sellers bailing out. The play is to lean bullish. That thin tail below is a low volume gap, and if price pulls back into it, those same buyers tend to defend and push again. Longs from the tail or the point of control stop below the tail, target the highs. Just respect that if it was pure short covering, the fuel can run dry, so confirm with volume on the next push. Flip it upside down and you get the B, a fat base at the bottom, a thin tail pointing up. This is aggressive selling that balanced at the lows. Often long liquidation, trapped buyers dumping their positions. Lean bearish. The thin tail above is your gap. If price rallies back into it, sellers tend to reload. Shorts from the tail or the point of control stop above the tail, target the lows. Same caution. If it was just liquidation, watch volume on the breakdown to confirm there's real conviction behind it. And sometimes there's no balance at all. Price opens, picks a direction, and just runs. One long, thin distribution with almost no rotation. That's a trend day. The play is simple but hard. Don't fight it. Buy the shallow pullbacks in an uptrend, sell the weak bounces in a downtrend, and hold on. One last tell, single prints. Those skinny, low-volume zones where price blew through in a hurry. They're unfinished business. Markets hate leaving gaps, so price very often comes back to fill them. Mark these zones. They become magnets and they become turning points. Now zoom out and watch it all connect. Balance builds a D. A breakout expands the range. The rally balances into a P, bullish. Then price stretches too far, fails, and snaps back to value. Sellers take control and carve a B at the lows. Every single move is just balance, imbalance, and the shapes they leave behind, on every time frame you'll ever trade. So read the chart as a conversation. Balance shows you where price is accepted. Sharp imbalances show you where it's rejected. When price stretches too far from value, expect a pullback toward the middle. When one side breaks out with real volume behind it, expect the move to continue. You're no longer guessing. You're tracking where the real money agrees and where it doesn't. And that's auction market theory. Not an indicator, not a secret signal. Just buyers and sellers deciding tick by tick what something is worth. Learn to watch the auction and the market finally makes sense. I'm Chris, the Trader Guy. If this clicked for you, come join us in the Discord, and I'll see you in the next one.